The banking sector has always been shrouded in mystery for most of the general public. To them, it is just an entity where you keep and take money from. Well, there is so much more to banks. Hello and welcome to our channel, folks. Banks are considered to be the backbone of the economy, but despite this, most of us don't even know how they function. Well, considering some of the banking practices, if people really understood how they worked, no one would ever trust banks again. So today, we are going to tell you guys about the 5 truths about money that banks do not want you to know. So let's begin the video. Number 1. Bank's right of set-off. One of the most shocking financial secrets on this list is a right of set-off which may wreak havoc on your money. When you have a deposit account and a loan with the same bank, this is very common. A right of set-off, also known as a banker's lien, gives the bank the ability to automatically and without warning access cash in your deposit account if you default on your loan. It may appear absurd that banks have set-off power, but it really makes sense. When you deposit money in the bank, you are effectively lending money to the bank on the condition that they would repay you when you request it. You've formed a mutual debtor-creditor relationship when you take out a loan, whether it's a car loan, a personal loan, or a mortgage loan. Why should the bank give you back your money? For example, your deposited cash, if you can't keep your word and pay them back. This provision is most likely specified in the fine language in your loan's terms and conditions. Making timely loan payments is the greatest way to prevent a right of set-off. Avoiding default is the only way to assure you won't lose money due to set-off. Transfer your cash to a third-party bank if you're still worried about your money. Set-offs only apply to deposit accounts held by the same institution that finances your loan. The bank will not be able to automatically remove your cash when transferring your funds and will instead have to pursue legal action to recover your funds. Number 2. Bank fees are negotiable. According to the 2012 World Retail Banking Report, 62% of Americans do not intend to leave their bank anytime soon, but that does not imply banks can get away with anything. Bank fees were highlighted by 50% of respondents as the second most common reason for switching banks, according to the analysis. As a result, bank fees are just as adjustable as credit card charges, even if you're in the wrong. Did you write a bounce check because you miscalculated the amount of money in your checking account? Call your bank right away to dispute the charge. By contest, I don't mean deny it. Rather, use your bank loyalty to plead your case for a bounce check or overdraft fee to be waived. Note how long you've been a loyal customer of the bank, list all of your accounts such as checking and savings accounts, car loans, mortgage loans, and so on, and emphasize your good standing with the bank, assuming you haven't defaulted and the fee you're requesting to be removed is a first-time offense. The essential thing is to keep going, be courteous, and refuse to take no for an answer. What most banks don't want you to know is that if it means retaining your business, they'll cheerfully waive a $25 overdraft fee. Number 3. Value of your money decreases when it is in the bank. Let me ask you a question. If you deposited your funds in a bank, how much interest would you earn? At first sight, it appears like at least a few percent is required for it to make sense, correct? However, when you look at the data, it's clear that this isn't the case. The largest institutions, such as Citibank, provide a paltry 0.5%. There are certain institutions that provide a greater return, but it is still less than 1%, especially considering interest rates are now at an all-time low. Consider that for a moment. While inflation is 2.25%, your money rises by 0.5%. Every year, the intrinsic worth of your money plummets. You'd be far better off spending that money right now rather than putting it in a bank account. In a few years, your money will have substantially less purchasing power than it has now. When inflation is high, as it is right now, asset prices such as homes and equities grow enormously, as we have seen in the previous year or two. A bank is a location where you may keep your money rather than make it. Add to this the added scrutiny from the government, and then you wonder why people don't trust the banks. Number 4. You can negotiate credit card rates. Credit card rates vary significantly amongst lenders. Some have introductory rates as low as 0% APR, while others have rates that exceed 20%. Furthermore, many credit card issuers offer enticing rewards programs, frequent flyer miles, or cash back to attract your business. Let's imagine you have a choice between two credit card offers, one with a low interest rate of 10% and one with a slightly higher interest rate but more rewards points. Call the rewards program's credit card company. Make sure your tone is neutral when conversing with the agent. Explain that you're debating whether or not to apply for the credit card since you have received a better offer from a rival with a cheaper interest rate. The customer care person will most likely promote the rewards programs while being tough in their focus on decreasing the credit card rate. But believe us, it works. We tried something like this once, and only after a couple of minutes did the initial APR rate of 17.999% that we received in the mail drop to around 13.99%. So never be too shy to get a better deal. Number 5. Fractional reserve banking. Whenever you check your account, you will see that all your balance is there, and the same holds true for everyone else. But the question that arises here is that if everyone's money is in the bank, then how do banks give out loans? Well, this can be explained by a system called fractional reserve. So, for example, if you deposit $1,000 in a bank account, the bank will use a fraction of that amount, say $900, to lend to people who need a loan or a mortgage. This phenomenon is known as fractional reserve banking, and your money is out there doing business for the bank and making more money for themselves. You can withdraw your money from the bank at any time, but imagine if everyone went to the bank at the same time to get their money. Remember the credit card crash of 2008? Well, this is exactly what happened. Banks gave out too much of the money, and when depositors came to collect, they didn't have the resources to give this money back. So as a result, the government then sets a rate for the amount of money that the bank can give out. Finally, though this isn't a secret, never take advice from your banker teller. Bankers desire to achieve their goals. Your best buddy could forget about your birthday or anniversary, but your bank will never do so. Banks want you to feel valued, and there's nothing wrong with that as long as it's not used to benefit the bank. Keep in mind that all bankers have targets to meet and deadlines to meet, and they'll always try to sell you their offers, which may sound appealing to you. You may end up taking a loan that you hadn't planned for, so always be cautious and read all the terms and conditions before agreeing to signing up for anything. So, in conclusion, a lot goes inside the walls of banks that most of us could never understand. So every time you guys decide to take a loan or put money in the bank, always remember to read the fine print of the papers you are signing. You never know, you might end up signing something that is detrimental to your financial security, but will ultimately favor the bank. So that is all the time we have today, folks. I hope you enjoyed this video. If you have any questions, then feel free to ask them in the comments below. And don't forget to show your support by liking this video and subscribing to our channel and view more of our amazing videos. Oh, and one more thing. Do hit that bell icon on your way out to remain updated about all of our future videos. We'll see you next time.